Hello everybody and welcome back to the Minted Undergrad. Today we're going to be discussing index funds and why they are one of my favourite investment instruments. Now for most people this is probably one of the better options available. They require little time and effort and often beat over 90% of hedge fund managers. So just a disclaimer, this is not financial advice in any way and it's for educational purposes only. You should look at all of the options available to you before investing. Now, what is an index fund? Well, an index fund, rather than purchasing one company and being in with that company when it goes terribly wrong or goes potentially slightly well, an index fund allows you to be in over 500 companies at any one time, or however many companies you want. So you take a portion of the losses, but you also get the gains, which hopefully allows it all to be leveled out slightly more. So even in the bad times, hopefully there are stocks available to boost you up and level out the losses. So index funds allow you to buy a portion of pretty much any fund you can think. If you want to invest in UK real estate, then you can do so for less than £4 with UKRE, an index fund that allows you to own a portion of many different investment properties in the United Kingdom. Or if you want to be a bit safer potentially and invest in bonds, then you can do so for £26 with VAGS. So one of the benefits of these funds is that there's really low fees, as the management companies really don't have much to do. They stick the companies together, shuffle them around every now and again, but other than that, there's very little for the management companies to do, so they don't have to pass on that many costs to the consumer. So you'll see many funds with less than 0.5% of management fees, or 0.07% in the case with some of them. And these funds are passively managed really. You have to do nothing, and the managers at these companies will adjust, tweak, and decide which companies to put in based on what they think is best. And now you're much less likely to lose all of your money than investing actively and picking stocks and timing what to do and just investing emotionally. Overall, index funds tend to have a lot lower risk with better returns on average. Warren Buffett has said that picking the right time to buy and sell stocks is a bad thing to do for over 99% of the population. If potentially the greatest investor ever recommends something, that's what I'm going to trust. Index funds also have huge diversification built in. The S&P 500 is made up of over 500 firms that determines your returns. If one firm fails, you're likely to have 499 other to help build it back up. And you're betting that long term the market is going to go up in value. It's almost always better to leave your money in rather than withdraw and reinvest depending on what you think the stock market's doing. And best of all, it's so easy. You don't need to spend hundreds of hours picking through stocks, going through investor briefings. You just get to buy a bit of the entire market in one go. Now, one of the most popular index fund investing methods is through something called a 3-fund portfolio. Your first index fund is a US market tracker, like the S&P 500. Your second fund is a total global market tracker. And your third fund is a bond market tracker. Now remember, with investing, it's always with a long-term focus. Minimum 5 years and potentially up to 10. Now, you may be asking, how easy is it to make this 3-fund portfolio? Well, here's an option straight away for you. For the US market, you want to go for something like IUSA from iShares. And then for your international fund, a good option is something like from Vanguard with VWRP, which is whole world and accumulating, so dividends are reinvested back into the fund. And then for your bond market, you probably want to go something like VAGS, which is Vanguard's total global bond market index. So it looks at all bonds over 1 year globally, and it includes those in the index. Now, for the composition of the portfolio itself, it really depends on what your investment horizon is and when you really plan on retiring. When you're younger and might want to be a bit riskier, you'd potentially put a bit more weighting on the total market and the US market index. And as you get older, you can build up the bond market, as it tends to be a bit more consistent and not as volatile. So when you're about 20 to 35, you'd probably want to be going between 70 and 90% in stocks and 10 and 30 in bonds. Of course, that is all just depending on what your risk tolerance is, so how much you're willing to see your investments grow or fall potentially. But then as you get older, nearing retirement, say you're 50, heading on between 50 and 65, you might want to go something like 40% stocks and 60% bonds, just because they are that little bit more consistent. Now for myself, I'm going 65% United States, 25% global index funds, and then 10% in bonds. And I've got a really long investment horizon. My current plan with investments is to hold and buy and hold and buy and just keep building up how much I've got invested until I plan on retiring, which I don't see happening anytime soon. Now remember, this sort of strategy is what Warren Buffett recommends for 99% of people, and it's probably what would get you the best returns over a long 40-year period if you're staying consistent, not withdrawing in the downturns and not going crazy when the market's booming. So overall, index funds and the 3-fund method is a great option if you've got a long future ahead and you want to invest for 40 plus years. It's a great way to really start to build your wealth heading into retirement before you can then switch to income-based stocks which start to pay you a little bit of money every month just to pay for your day-to-day life. So thank you very much for watching. Please do like and subscribe, and stay tuned for the next one.